We are now joined by Oaktree Capital Management co-founder and co-chairman Howard Marks to talk all about it. We've been talking about the fiscal issues, right? We've been talking about the monetary conundrum that's been happening for now well over a year for the Fed chair. If you think about the potential for fiscal to really upend how investors think these days, how much is the government debt loads in the U.S. and abroad really changing the calculus?
Well, look, Sonali, I think it's unfortunate that the U.S. behaves like a country that has a credit card with no credit limit, where the bill never comes. I mean, nobody can think that's a good idea. You would think that there has to be a point at which our debt or our deficits become too much, reckoned as a percentage of GDP, usually. Nobody will tell you that point doesn't exist. Nobody will tell you where it is. Nobody's exercising fiscal discipline in Washington these days. Last year, we had a deficit in the trillions in a period of prosperity. Not supposed to happen. All very unfortunate, but A, nobody can tell you when it becomes a problem, and B, nobody can tell you what to do about it. You can't eliminate the U.S. from your portfolios. People who've said to do that in past years are now looking pretty bad.
Yeah, I was going to say, if you had followed that advice, you'd be in a world of hurt right now in terms of relative performance. And you said that no one can tell you where that point is, but that's exactly what I'm going to ask you. Where do you think that point is? Is it something that we're approaching, if you don't want to exactly pinpoint it?
I don't want to exactly pinpoint it. I want to say that I'm among the people who can't tell you where it is.
Fair enough.
One of the many.
Yeah, I think every time I come on on Bloomberg, I quote Mark Twain, who said, "It ain't what you don't know that gets you into trouble. It's what you know for certain that just ain't true." I certainly don't know.
I wonder what kind of opportunities you're finding. I'm always interested on the distress side about how sort of target-rich the environment is. I think that says a lot about our economy. All the economic surprises that we see are to the downside lately, and rates remain high. Does that make this interesting for you?
Well, I think it is interesting. I mean, we went through a really slow period from 2009, when the Fed took the Fed funds rate to 0 to stimulate the economy, to 21 when they decided to lift it to fight inflation. And in that 13-year period, there was very little distress because it was a very benign environment for companies. Now, as you note, interest rates are higher. That gives us more of an opportunity. And importantly, there were a lot of leveraged transactions done in the period I described, where companies were burdened with capital structures, debt structures, that did not anticipate a 500 basis point or 400 basis point increase in rates. So, to put it in short, it was a great time to be a borrower because rates came down and business was prosperous. But right now, and I think going into the future, leveraged companies will not be able to renew their leverage as easily, and the cost of doing so will be higher. So that gives us better opportunities than we've been seeing. And, just to put it in brief for your listeners, 6 years ago, you had an idea, you went into the bank, you described it, they said, fine, we'll give you $900 million at 5%. Now it's time to renew your debt. You go in, you describe it again, and they say, good, we'll give you $500 million at 9%.
Where do you think most of that pain is going to come? Because there's the private equity universe that's clearly grappling with that refinancing pain. There's the commercial real estate market. And equity investors seem to be ignoring any leverage that might be under the system still. What should they be watching out for?
Well, clearly, it'll be in highly levered situations, and you named two of them, private equity and real estate. Leverage, the use of debt to amplify your returns, it has been the lifeblood of these two asset classes, and they've done extremely well as a result. It was very, very salutary for them. But that's where the pain will come in the future. You can't increase a company's debt service cost markedly without affecting its returns. And in certain sectors of the real estate world, mainly retail and office, there are fundamental questions. So you put that together, we think you'll see some disruption, which will give us and people like us opportunity. This has been a really tough period for lenders, which is what we are, and a really tough period for bargain hunters.
Right. Well, I want to talk a bit more about the business of lending and what's going on in the private credit industry. Of course, a month or two ago, we saw Pluralsight, backed by Vista, basically transfer its assets into a different subsidiary to obtain more financing from its sponsor. That's become a little bit of a battle cry. You see lenders basically asking for Pluralsight protection right now. I won't ask you specifically about what happened with that episode, but how do you see this evolving in the industry? Do you think that we're going to see more creditor-on-creditor violence, as some have been calling it?
Well, people tend to do what they can to enhance their position financially. Most people will stick to what they can do legally. Some people will stick to what they can do ethically. There's some question about what that means. But people, if there's an opening, people will take it for the most part. And there is an opening for what you call creditor-on-creditor violence. That is proactive efforts to enhance your situation financially at the expense of somebody else. And the important point is that it's up to lenders to study the documentation well enough to prevent it. That's it.
Are you active in office space right now? Because it seems like the perfect storm for anybody who has the financing. We talked to Yigal Namdar, a real estate investor, a couple of days ago, who is getting like 70% off really big, important office buildings in New York, the capital of the world. Like, how can that not come back?
Well, the question, Matt, is very simple. Let's say you're getting 70 off. Is that enough? And the mere fact that the price of something is down doesn't make it a buy. It has to be that the price is down more than it should be, given the fundamentals. And, I think it's going to be up to the experts, people who've made their life in that world and with success, to make that assessment. I think that if there is a bunch of real estate funds formed this year, somebody who puts all their money into office and somebody who puts none of their money into office, one of them will be the best performer. I just don't know which one.
If you have these struggles that are still under the surface, we are just about, 5 days away, really, from bank earnings. And the question is we enter this era where they're about to meet new capital rules as well. Mm-hmm. Are there still just tremendous stresses under the system that people are not noticing?
Well, it's the small to mid-sized banks, the community and regional banks that are heavily weighted toward real estate loans. The biggest banks, over $250 billion in assets, don't have much of a concentration. They're not at risk. But some of the smaller banks, I think on average the banks under $250 billion in assets, loans on real estate make up 160% of their regulatory capital. So some of them will find pain, especially the ones who lent above average and concentrated in regions that are troubled and so forth. So, I don't think it's a systemic risk that's going to put us in the sink, but I do think that you'll see some companies in trouble. And, one by one, the authorities may have to bail them out and may well do so.